Hi, Jeremy Peterson here with Vesta Real Estate in Ogden, Utah. It's time for a market update. Let's take a look at what happened in 2024 and let's talk about what we think will happen in 2025. Our first chart here, we're going to take a look at house prices, and this is what everyone's always concerned about, is whether their house is going up or down in value. As you can see here, for 2024, the trend was up. We increased in prices about 5%. This is, of course, after a scary 15% decline after the peak in June of 2022. But the last 2 years have seen kind of a steady step upwards in prices, and it looks like that 2025 will likely be similar. We'll watch and see, and we'll talk about some of the market forces that will affect that here at the end of the video. Oh, by the way, if you want to know what your home is worth currently, with everything bobbing up and down, give me a call. Be happy to do a free market analysis for you. Our next chart, we're going to take a look at days on market. And as you can see here, it looks like we've kind of gotten into a regular pattern with higher days on market in the winter and, of course, lower numbers in the summer. If we take a look at the bigger picture here, you can see that even though we're, in January here, we're coming up on our peak for days on market, we're still below where we were during the bubble in 2007. So houses are still moving at a steady clip, and what that tells me is that there is still high demand for housing, even in the high interest rate environment we're in. There is still demand for people to get into homes here, so that's good. We're not in a total buyer's market, although this time of year in winter is the best time to buy, by the way. So if we take a look at sales volume in the big picture here, we see that it looks like we might be reaching a bottom for this market cycle as far as sales volume goes. We reached our peak when interest rates were low several years ago, and obviously we've come down in sales volume since then, and it looks like we might be reaching the bottom. So that's good news for the market, and we can hope that forces combine to increase sales volume for everyone. Now, looking back at this year, sales volume was up a little bit, down a little bit, and then at the very end of the year, we had this huge spike where we had 35% more sales at the end of the year than we had the prior year at that time. So what caused that? That was related to interest rates. And at the end, or kind of towards the end here of 2024, we had interest rates drop almost down to 6%, which was a breath of relief, and everyone jumped on the horse and got out there shopping and bought a house. So that just tells you how much pent-up demand there is right now with affordability, where interest rates are, or with interest rates being where they're at currently. So this is kind of the dynamic. If interest rates dip, we should see a surge, and if they spike, we'll probably see buyers pull back until things settle down again. But interest rates are elevated relative historically. Now, are interest rates going to go down this year? Well, we'll talk a little bit more about that in a second, but I don't think so. And one of the reasons that is that, and one of the reasons that interest rates are high, and I'm just going to talk about this briefly and not get too bogged down in esoteric banking talk, but the Federal Reserve back in 2008 during the financial crisis bought a ton of mortgages, so many mortgages, trillions of dollars of mortgages, and that bailed out the mortgage market, which kept mortgage rates low so that things could move. And in successive periods of time here, as they felt like they needed to support the market, they bought more mortgages. And in 2022, just as interest rates were increasing, the Federal Reserve decided that they were no longer going to buy mortgages, and that they were going to just let them roll off their books as they were refinanced or got paid off. And so they're not in the market to buy mortgages anymore, which means that the market is on its own as far as supporting itself interest rate wise. The free market's going to determine risk based on all kinds of underwriting criteria, and rates are going to be a little higher because of that. If the Federal Reserve were to change its mind and buy mortgages again, then risk would drop for those creating mortgages and interest rates would drop accordingly. But I don't see that happening in the future. unless there is some kind of enormous crisis. So let's talk about what 2025 has in store for us. This is a transition year. We have a new administration, they have new policies, and we're going to see how those policies affect housing. One of the big things that is on the new administration's agenda is to privatize Freddie Mac and Fannie Mae. So for those of you unfamiliar with this these institutions, basically they are giant mortgage companies that underwrite and finance mortgages for a significant portion of the housing market. They are government-supported enterprises, and they were created to help grease the wheels of the housing market. Well, over the decades, because they're really old, over the decades they've morphed. They've become these giant institutions, and so the proposal is to take these out of the sphere of government and just make them private enterprises again, or just private enterprises, period, and do that. So what would the implications be for the housing market? Well, that would mean that these would become more market-based underwriting lenders. There would be less temptation for political intrusion or influence on them, in making underwriting decisions or whatnot. It means that it would be more free market. It might mean that underwriting guidelines would ebb and flow based on market conditions and less so with political conditions. So that's a dual-edged sword, because sometimes it's nice to have easy underwriting guidelines, and even when conditions are tough. But in the end, a free market solution for this is going to be beneficial for everybody, especially because it takes these institutions off the hook for a taxpayer-funded bailout, which is what happened in 2008 and 2009 during the Great Financial Crisis. So the second issue to affect housing is going to be tariffs. As tariffs are levied on different goods, especially building materials, looking at Canada and lumber specifically, that is going to increase the cost of building a home, which will increase the cost of the end cost of a home and the price of homes. So that will be inflationary for house prices, not necessarily for a good reason. It means that fewer homes will be built because of that. Just depending on how tariffs go, we're going to have to watch and see with that. A third issue affecting housing is deportations. Obviously, a lot of our labor to build things comes from outside of the United States. And so depending on how that goes and who is deported or incentivized to deport themselves, that may affect the labor market and increase the cost of building a home. So we'll watch that. That's going to be something that plays out over the coming months, and we're going to have to wait and see with that. Regarding oil prices, the current administration has advocated for increasing supply of oil, which in theory should decrease the cost of oil. Oil is used to fuel transportation, which means transporting goods to and fro across the United States, to and from the United States, which includes building materials. If oil were to decrease in price, that would reduce the cost of things that we buy. And so again, that's going to be a wait and see how that shakes out. Finally, we have the Fed's fund rate. The Fed is going to wait and see how all these other policies play out and how they affect prices. Obviously, we'll see what's going on. We'll watch, and we'll have another market update to you soon. In the meantime, if you need to buy or sell your home in this market, give me a call. I'll be glad to help. Thanks for tuning in.